Now the topic before us is your money, your choice, understanding demand and time deposits. We go to the bank and deposit our money with the banks. Now the question arises, why do we deposit our money with the banks? We may be earning some interest on our deposits if we keep it with the banks. Otherwise, also, if we are having our money in the form of physical notes or coins, then there are also the chances of theft. So, it is proper for us to keep only few money with us at our house and deposit the balance with the banks. Broadly, the banks offer two types of deposits. One is demand deposits and the other is time deposits. Now we will understand what is the difference between demand deposits and time deposits. Each of these deposits has its own features and we should choose the deposit where we should park our funds on the basis of our requirements. First, we will discuss demand deposits. As the name suggests, demand. When we demand, the bank will return the money back to us. We have deposited the money with the bank, and if we need the amount now, we will go to the bank and will ask for back of the paying back the amount which we have deposited with the bank. These are demand deposits. So what is written? Demand deposits are those that can be withdrawn at any time without notice or with minimal notice depending on the bank's policies and the type of account, because there are large number of commercial banks in each and every country. There may be some minor difference in the type of accounts or the term and conditions of the accounts. Broadly, the demand deposits are of two types, saving account and current account. Suppose we go to the bank and we have say deposited $1 million with the bank, and we go to the bank and say that pay me in cash. Now the bank will immediately pay you if you are having saving or current account. But it may be possible that they may not be having cash at the relevant time. They will ask for some time, 30 minutes, 1 hour, so that they can arrange funds. So these are the demand deposits where you can withdraw your money at any time without notice or with minimal notice. So now, first of all, saving account. Saving account is meant for individual customers. If we are a shopkeeper or a businessman where we have to deposit our amount with the bank off and on many times in a day or withdrawal money many times in a day, then saving account is not for them. It is for individual customers where there may be some restriction on the number of transactions in a month. When we deposit our money with this bank in our saving account, we earn some interest on our deposit. the interest which we earn on the saving account is less as compared to fixed deposit or recurring deposit. Saving account is very liquid. Liquid means we can withdraw our money at any time without notice. Next is current account. Current account is primarily meant for businessmen. If we are a proprietor or a partnership firm, or we are running a trust, or there is an association of persons, or there is a public or private company, or big or small organizations, all these types of organizations or firms have to open current account with the bank. Why? Because there is no restriction on the number of transactions which they can do on any day with the bank. That is, they can go to the bank any number of times in a day to withdraw or deposit money. Generally, no interest is paid by the bank in respect of the amount which is lying in the current account. Rather, the banks may charge some service charges from the customer for the maintenance of the current accounts. Next is time deposits. As the name suggests, here the money is parked with the banks for some specified period. Time deposits are also known as term deposits or certificate of deposit. Time deposits are those that are locked in for a certain period of time. In the case of demand deposits, we were in a position to withdraw our money at any time without notice or with a minimal notice to the bank. But in the case of time deposits, we park our funds with the bank for a specified period, which we opt at the opening of the account. The interest which we earn from the bank on our deposits is somewhat higher as compared to demand deposits. We can broadly classify our time deposits into two types. First is recurring deposit and the other is fixed deposit. First, we will understand recurring deposit. As the name suggests, recurring means reoccurring. Reoccurring, recurring in the recurring deposits means that we have to deposit some fixed amount each month for a specified period. It may be possible that we deposit $100 per month for say 1 year. So far as Indian banking system is concerned, the minimum period for a recurring deposit is 6 months, and the maximum period for which an RD account, recurring deposit account, can be opened is 10 years. That is, if we opt for $100 per month, maximum we can operate our account or we can deposit this amount per month maximum for 10 years. After that, your account will be closed and you will be paid whatever you have earned or whatever you have deposited. Your principal amount plus your interest will be given back to you. Now the question arises, what is the minimum amount which a customer can deposit in his recurring deposit? That is, what is the minimum amount which we can opt, while opening a recurring deposit. Whether there is any limit, it varies from bank to bank. Naturally, the private banks are established with the main motive of earning profit. So naturally, private banks, in the case of private banks, the minimum deposit amount in respect of recurring deposit is somewhat on the higher side. And in the case of public sector banks, where the main motive is welfare of the general public and not to earn maximum profit, is on the low side. That is, in the case of public sector banks, the minimum amount for which a recurring deposit account can be opened is somewhat on the lower side. We take for example, in the case of State Bank of India, we can deposit rupees 100 per month in a recurring deposit account, minimum amount. And in the case of we take another example, in the case of HDFC Bank, minimum amount which can be deposited in our recurring deposit is 1000 rupees. The main purpose of an opening a recurring deposit amount is to save money on a regular basis. Why we deposit money on a regular basis? Sometime we may have a long-term goal. That is, we may have to incur expenses on the higher education of our child. Then we start thinking in advance, 5 or 10 years in advance, that we will require money after 5 or 10 years. Then we should start depositing some fixed amount every month. It may be possible that we are having a dream to purchase our house. Say after 5 or 10 years, we will start depositing some money every month in the shape of recurring deposit, or we may have to incur expenses on the marriage of our child, say after 10 or 15 years. Even in that case, we may think of opening of our a recurring deposit in some bank. Next is fixed deposit. It is also a type of time deposit. As the name suggests, here a lump sum amount is deposited in the bank. Say we deposited $1000 in the bank, one time a deposit. We deposit it for say 2 years. Now the question arises whether we can withdraw money from recurring deposit or fixed deposit if the circumstances come that we have to meet some emergency expenses. There is a health issue in the family and we are have deposited money in recurring deposit, or we have having an FD with the bank fixed deposit. Yes, you can withdraw your money even in the case of recurring and fixed deposit, but in the case of both, whether it is recurring or fixed deposit, the bank will charge a penalty from you. Though it is the normal procedure over the terms and condition may vary from bank to bank. However, they will charge penalty from you, or they may reduce the interest which is lying into your credit, and they may close the recurring deposit or fixed deposit account and pay you the interest as the system will calculate, computer system will calculate, because all the terms and conditions are already fed into the computer system. In the case of Indian banking system, the minimum period for a fixed deposit is 7 days. Here you can see that a certain amount is put in. This amount earns interest at a fixed rate of interest. Here, if we say deposit $1000 and the banks are giving say 7% interest per annum. And suppose after a few days the rate of interest increases or decreases, but the banks will give you only this amount. Though the interest may decrease to 6.5 or increase to 7.5 after a few days, the banks will neither decrease nor increase the interest on your fixed deposit. They will pay you the interest as already promised by them. Interest is earned till the date of maturity, and when your account has matured, say you have deposited your money for 2 years, and after the completion of 2 years, whatever amount which you had deposited and the interest which has been earned by you, the total of both will be given back to you. The maximum period for a fixed deposit account is normally 10 years. The interest which we earn on the fixed deposit is somewhat more as compared to saving accounts, because here the money is locked in for a certain period of time. We cannot withdraw it on demand. If we withdraw it, the bank will reduce the interest or charge penalty. Minimum amount for a FDI account is generally rupees 1000. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.